All right, it is Fed decision day. The central bank is ready to make its first policy announcement of the year, 2023, beginning today at 2 o'clock in the afternoon. We will be all over it. We are expecting rates to go up again this afternoon by 25 basis points. The market is fully pricing in that quarter-point hike. Joining us right now is the Wall Street Journal's chief economics correspondent and the author of the must-read $1 Trillion Triage. Nick Timiraos is here. Nick, great to see you.
Thanks for having me, Maria.
We were just talking about your piece this morning and your focus on pay gains shrinking. We spoke earlier with Barry Knapp, one of the leading economists out there, and I want to get your take on what the managing partner of Ironside's macroeconomics told us about an hour ago. Watch.
There's a number of ways you can reduce your demand for labor, right? One is you can work people fewer hours, and that labor income, which is
He's talking about fewer hours worked, Nick, very similar to what you're writing about this morning in your column. You write that pay gains shrinking in a new sign of easing inflation. What would you say about wage pressure today?
So, if you look at this report that came out yesterday, the Employment Cost Index, it's not something a lot of people pay attention to, but the Fed pays a lot of attention to it because it's a very high-quality measure of compensation, and it showed compensation slowed at the end of last year. But, Maria, if you ignore the past 3 years, the pandemic period, wage growth was still higher than in any quarterly report for the previous 20 years. So we were looking at very high wage growth, but not quite as bad for the Fed as what we were looking at earlier last year. So what does that mean for the Fed? If they can get wage growth to slow down without as big of an increase in the unemployment rate as maybe some people were thinking just a few months ago that they might need, then that would be, that would be good for everybody, right? The Fed doesn't have to take as much recession risk to try to get inflation down. And they pay a lot of attention to wages because when you get through some of these supply chain distortions, home prices coming off the boil, what you're left with when you're trying to figure out what underlying inflation is going to be, it's really wage driven. That's the concern of the Fed. And so the report yesterday was closer to 4% annualized wage growth. Earlier reports had been closer to 5.5%. And if you have a 2% inflation target, Maria, that is just eye-wateringly high to have 5.5% wage gains. So 4% is going to be seen as something that's more manageable if it's sustained.
Yeah, but Nick, you also write that employers spent 1% more on wages and benefits last quarter versus the prior 3 months, a slowdown of 1.2% increase in the third quarter. It sounds like you believe that inflation, certainly as it relates to wages, has peaked. But what about employers still spending more on wages and benefits last quarter?
Yeah, I think that's the issue here for the Fed, is that things are moving in a better direction if wage growth has indeed peaked. But the worry is that it's going to settle out at a still uncomfortably high level. So let's say we get through this. We had 7% inflation last year, 9% in June. It's coming down now. It's expected to come down more this year. I mean, the market, if you look at break-evens, has inflation coming down a lot this year, close to 2%. The Fed's saying, no, we think it's going to be closer to 3.5%. And so if you get to that place where you still have 3.5% inflation, the Fed has a 2% inflation target. They're going to be very hesitant to declare victory at 3.5%. Now, you don't have to take as many risks. You don't risk having a huge recession, perhaps, to get inflation from 3 to 2 the way you do to get it from 5.5 down to 3.
Yeah.
So that's going to be the big question this year is in 2021, the Fed said, we think this inflation is going to be transitory, and they were wrong. Now the concern is that the disinflation we're going to get this year is transitory, and that inflation actually settles out at 3 and then starts to reaccelerate. And that is not something the Fed is going to want to see.
Great point. John Lonsky.
I hate to say this, Nick, but I think the only way the Fed's going to get rid of inflation once and for all is by way of a recession. A lot of demand destruction, a weakening of the labor market so that you quickly bring wage growth down to the 2.5% to 3% that we had back, prior to COVID. And remember, it wasn't that long ago that we had an underlying rate of inflation very much on the low side, 1.8%, a core PCE price index prior to COVID. And with that, we had wage inflation of only, 3%, while the unemployment rate was also a very low 3.5%. So prior to COVID, many argued that the Phillips curve was dead and gone. It was finished with. And now all of a sudden we see that the Phillips curve is trying to come back. That is, we get this unfavorable trade-off between wage growth and the unemployment rate. Perhaps we can go back to what had become normal prior to COVID.
Yeah, that's absolutely right. And I think that's going to be the big debate at this meeting and probably the next couple meetings. You're going to have some people who might be willing to argue, look, if wages have peaked and if wages are now, the rate of growth is slowing, then that means we do not have the conditions for a wage price spiral, and we do not have to be quite as concerned as we were a few months ago about really weakening the labor market to get inflation down. There will be other people who are making exactly the argument you're making, John, which is even then you have a 3.5% unemployment rate. I mean, there's a risk, John, that this Friday you have a really good payroll number, and if you continue to add 250,000 jobs a month, it seems unlikely that you're going to have the unemployment rate holding at 3.5%. It could actually go lower. Wow. And, all the macroeconomic models inside the Martin building at the Fed are going to say, whoa, that is not consistent with getting inflation down. So that, I think, is going to be the big question. If wage growth has peaked, what next?
So Nick, just to put a bow on all of this, does this then support a 25 basis point hike today, a 25 basis point hike perhaps in March, and then a pause? Are you expecting a cut at any point in 2023?
It really depends on your outlook for the economy, Maria. So, the market is pricing in a half point of cuts in the last part of the year. But the market has a much more optimistic view about inflation. They see inflation coming down faster than the Fed. And the bond market, really the Treasury market, is anticipating a recession. So if you think we're going to have a big increase in joblessness and that's going to get inflation down faster, then it's not crazy to think that you would see cuts. But the Fed is saying, no, 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 this time is different. With inflation as high as it is, they're saying that their reaction function, how they would respond to a downturn, will be different than in the past. They will be slower to cut because they will want to try to make sure that they don't repeat the mistakes of the mid-1970s. So, the pausing debate, yes, we're getting there now. I expect a 25 basis point increase today because they want to see what the effect of the earlier moves were. But it really depends on the data from here, Maria.
Nick, real quick, what's the most important item you're looking for from Jay Powell when he gives that press conference? Is it where he thinks the terminal rate is going to go? Is it something else? What is that nugget that you're looking for?
Yeah, have their expectations of the terminal rate changed from December? And to that, I think the point John raised was key. How much unemployment, how much do they think they need to see unemployment rise? Has their outlook about the need to weaken the labor market changed as they see wage growth coming off the boil? If they think they can get that soft landing, does it make them, more open to a pause in the spring than would otherwise have been the case? I think that's going to be the big question here.
Nick, it's great to talk with you. Thanks so much. We will be watching. Nick Timiraos from the Wall Street Journal.